2022 to order. Roll call, please.
Miles Lawler,
Here.
David Williams,
Here.
Joe Mahoney,
Here.
Aaron Soltz.
Here.
All right, we have all four trustees present. Plan attorney Pedro Herrera is calling in via phone, and I believe also the Salem Trust custodian Inez Garcia is on the phone as well.
Okay. Moving to
Hi.
hello. Move number 2, public comments. Seeing none, we'll close 2. Move to 3, approval of minutes. Look for a motion.
I'll make a motion to approve the March 14th, 2022 meeting minutes.
Second the motion.
And roll call.
Aaron Soltz, how do you vote?
Yes.
Joe Mahoney,
Yes.
Miles Lawler,
Yes.
and David Williams.
Yes.
Motion carries 4-0.
All right, moving forward. 4, new business. Seeing none, we'll close 4. Move to 5, old business. And first is proposed ordinance amendment, 5th trustee residency requirement.
That one has passed first reading and has been sent to the state along with the no impact letter. It's on the agenda at the next commission meeting for second reading. And I'll send out a notice and let you all know, and let Mr. Geiger know as well.
Okay, do we have to wait to appoint him until the second reading? I mean, can we do a motion now to where we appoint him pending the approval by city council? Can we do that now?
I say yes, but probably Pedro should chime in. Pedro, did you hear that question?
I did. So I don't see a problem with making the appointment essentially contingent on final approval from council.
Okay. Somebody want to make that motion?
I make the motion to fill that spot
Second.
pending the approval of the residency requirement by the city commission. The second reading.
And that's Charles Geiger.
Yes, Charles.
Second motion. So roll call?
Aaron Soltz, how do you vote?
Yes.
Joe Mahoney,
Yes.
Miles Lawler,
Yes.
and David Williams.
Yes.
All right, motion carries 4-0.
All right, moving on to 5B, proposed ordinance amendment, enhanced multiplier.
So I think this one is I'll jump in and then anybody else can fill in as well. I think if you guys recall, we've been trying to work on an ordinance amendment that would provide for essentially an enhanced multiplier rather than purchasing airtime or additional time in that fashion. So we were working on enhancing the accrued benefit portion. I guess is how it's described in the ordinance amendment. I think we've forwarded the language over to Doug to make sure that he's okay with the proposal. And then I believe the plan was to go ahead and forward that over to the city, potentially for its review, but obviously presuming it's okay to get onto the council agenda.
The only question I have about it, Pedro, is it has the date of October 1st, 2010. Police officers hired after October 1, 2010. Is there a reason why we're excluding officers hired before then?
I'm not aware of one. I think
I guess
I thought that was. I think that was. I was kind of working off of that date, but I thought that there was some. I thought you guys had a reason for that. I don't have a reason specific from my perspective. It could be any police officer, I guess. I don't know. Obviously what the impact would be in terms of a cost. I can't imagine it would be anything more because the members are bearing the full freight essentially. So no, I don't. I mean, there's no legal reason other than if you guys have a basis for that. I think that was just language that was initially being proposed.
Okay. Yeah, I would like to strike that. Looking at our current employee roster, the longest tenured is 1998. So either we can just take out that entire section where it says a date, or we can replace it with like October of 1997, just so we don't exclude someone.
Okay, yeah, I mean, I know at the last meeting we had discussed, I think it was removing the 90-day deadline, as well as, limiting it to, those members who had, between 15 and 20 years of service to expand it to more folks. But I don't know, but, I guess to your point, that date was in there before, kind of before I started working on it, and since we hadn't really addressed it, I left it. But we can just leave it open-ended so that any police officer member has the option to do this if they want to, provided that they're vested. I think that was the only requirement.
Okay, that's my opinion. You want a consensus from the board?
Yeah, I mean, I think if you guys are okay with that, with essentially just opening it up to any police officer that's vested, I think that would just be the only. As long as the board is comfortable with that, we could just remove. I'll remove that deadline, or rather that date, not deadline, that date, and then we can kind of go from there.
Okay. Is anybody opposed to removing?
Again, I don't know. And maybe you guys have a little bit better historical context as to why that date was included. But assuming that there wasn't any reason, we could just remove it. And it sounds like there wasn't really. So.
Yeah, I don't recall why it
Right.
was in there to begin with.
Yeah, I'm not opposed to removing it.
Yeah, no, I'm in favor of
Okay.
removing it.
Yeah, so it looks good. If we just remove that, I think we're ready to move forward with that.
Okay, and I think so. I think, and I guess I described it earlier, but I think the plan is, it's not going to come back to the board for your next meeting. It's just going to essentially, once Doug is okay with it, we'll send it to the city, and then we'll kind of move forward along that track with our actuary preparing the impact statement by second reading.
Okay. And then do you need Michelle to give you an updated mayor council list?
Yes, I'll send it over.
Probably.
There's actually a new format that the city clerk prefers. I'll send you the format over, and it'll have all of the updated.
I could just get that from the website. That's not a problem.
Okay.
All right. Moving on to 6 reports. And up first is Salem Trust, Inez Garcia.
Hi, good afternoon. I don't have any reports to present at the moment, but I did want to speak to you guys briefly as an introduction. I have taken over since Mindy has left in March. So I will be hopefully seeing some of you at the conference that we have coming up in Orlando. I don't know if you'll be in attendance, but I will like to meet with you guys later on the year to discuss a little bit more about our pension portal, which would be a good alternative to consider when moving over to that platform. So I'm hoping to have some brochures available preliminary at the conference. So if you want to stop by the Salem booth, we'll have some information that I'd be glad to present it to you guys to see what options you guys would like to go with to move forward. But thank you for the few minutes to introduce myself. If you need anything, please feel free to contact me. If not, I'll continue to work with Michelle on the day-to-day things that are needed at Salem. Thank you all.
Thank you. All right, next is 6B reports, and it's Johnstrom.
Okay, so I passed out 2 books. The first one should be a little bit thicker. It's the performance review. And then the second one, it says international equity. Just a search. I wanted to discuss our international exposures and if we can further diversify that. So before I get into the thicker book, you guys all follow the market, so today is not a good day. This quarter has not been good. Obviously, inflation numbers came out last Friday, higher than expected. In my eyes, they were not higher than expected. I think we all go to Publix and buy things, and I don't know why the market's going so crazy because we all thought that this is what was going to happen. But basically, the fear is that the Fed on Wednesday, they meet at 2. They're supposed to raise it 50 bips or 0.5%. And the fear right now is they're going to raise it 75, so a little bit more aggressive than what was already anticipated in the market. Tomorrow, the producers index comes out. So people that make this stuff, their inflation numbers are coming out. So I think that people prior to know what that number is going to be, and it's going to be high. Basically the fears of inflation, but to me, they've been here, and I've been paying a lot more. I was just in Chicago, and Jesus, I'm glad I don't freaking live there. We're going to be in for a bumpy ride. The S&P, give or takes, at 3,800 now. One silver lining is at some point, the valuations on these companies, people are going to want to start buying back in. I don't know when that is, but the market is a whole lot cheaper than it was to start the year. The numbers you're seeing here on just the numbers are going to be bad. Next time you see me, they're going to be bad. They're bad for everybody. This plan here has made a lot of changes the last, give or take, 3 years. And you'll see that on a relative basis. I kind of joked before, relative, how high we rank compared to the thousands of plans in the country. So the changes we have made the last 3 years from what we had have worked. So that's the one silver lining. And then, last year we had a great year. And Doug, your actuary smooths that out. So this year it's not going to be good. But we smooth that out over 4 years. Your actuary gets a payment, and then we amortize that over 20. It's not going to be given last year's return, this year kind of balances it out. But I got really nothing good for you on the investment front. Just that we're going to be in it for, I'll close just with consumer sentiment hit an all-time low last week as well. And over the last 50 years, though, when that has troughed, so we're getting close to the bottom. It can't get much worse, but when that does hit the bottom, the last 50 years, the 8 times it's hit the bottom, the market's up 25% from that bottom going forward. So the only thing I don't know is that when that bottom will be. But we hit a record low last week, so we got to be getting close to there. So I think with inflation, people got to stop buying stuff. I know that I'm a very conservative guy in general, so I'm not buying unless I have to do stuff. But people will stop buying stuff, and prices will go back down. China just reopened up, so their exports last week alone just are stuff starting to come back out of China again. So the reason for inflation pretty much is supply chain and then the cost of gas. So if the supply chain stuff's coming from China again, so that should push prices back down. The gas, I'm not trying to predict. We're going to hit $6 a gallon here this summer. It's going to get bad, but you would think at some point that would mean that we would stop driving, but that has not been the case thus far. But when gas, all those trucks are carrying stuff. When it's more expensive, that raises the cost of goods. Ending on a positive there is when sentiment's the lowest, we'll get there soon. Market's up 25% from that point. China's opening up, more goods are coming, supply chain should ease a bit, and that should start to alleviate inflation. But nonetheless, the market's down today. Big fears. Tomorrow's a big day on the number we get, and then we'll see what happens on Wednesday. But I do think the inflation will start to slow down here. It can't keep going at this pace. And if I'm wrong, then I think we're all screwed. So again, in saying that though, when I go through this book, allocation-wise, we're good with your policy. And then on a relative basis, not only for the fiscal year, everything that's happened, we're doing well relative. And then your 3, 5, 7, and 10-year numbers are ranking very high relative to every plan in the country. So in the thicker book, opening up to pie charts on page 12 and 13. So on 12 and 13, so far this year, not only have stocks gone down, but bonds have gone down half as much. So with today, the stock market's down probably 20%, but bonds are down over 10. So usually when stocks go down, bonds go up, but with rates rising, that has not been the case. So when I look at this, the only thing that I can kind of see is that the real estate, which is in the yellow, has been the only positive spot in the portfolio. And because of that, it is now about 11% of our fund. So I don't view that as a bad thing. Real estate, you'll see, had a huge quarter. American did very well, and it's just a larger piece of the pie right now. So that will get back to kind of our 10% target that we have. It's just when stocks and bonds have come down as much, real estate's been positive. That's going to be a little bit bigger piece of the pie. But other than that, our managers are in line with how they're supposed to perform. So no major changes at this time. And then if you turn to page 18, just getting into the numbers here. So I'll point out a few. So the very top line there, we were down over 5% for the quarter. Like I said, I have some plans that were down 6 or 7 for the quarter. So everybody's hurting. For the fiscal year, we are down net of fees, negative 0.83. And when I mentioned just being relative, I will say that I have had some plans that were down for this book here, 4 to 5%. So when I see it, all the numbers that I see, only being down less than 1%, it's not that bad as it could have been for some other plans that I currently consult on. And then if you go to the longer term numbers here, the 1, 3, 5, 7, and 10, when I mentioned relative to plans around the country and in Florida, if you see those parentheses, when you see low numbers there, so a 3-year at the 23rd, 5-year 25, 10-year even at 28, so that 10-year number, that 20, it means you did better than 72% of the plans around the country. So pretty consistently, we hover longer term between, pretty much in the top quartile amongst all public plans in the country. So that's plans our size and plans that are billions of dollars that have all that crazy hedge funds, private equity, all that stuff in there. So we have made a lot of changes over the last several years, but I think all of those have been prudent, and you can see it in the numbers. We've done everything that's thrown at our way. Right now, it's we're getting a lot, hit in the face a lot right now, but on a relative basis, it's doing extremely well. So when I kind of look at the managers going down on page 18 on the domestic equity side, this board used to have a manager called Dana. That was probably 4 or 5 years ago. Some underperformance, made some changes. So we have half of our domestic equity in those index funds. So just get us exposure to the market, and then we have active value, and then active on the growth side. So during this quarter, those growth companies, again, just think those large tech companies got hit on the chin pretty hard. So that's why you can see for the quarter, MFS growth was down 12%, but a lot of every growth manager is down huge. Just all those large tech companies got hit really hard. On page 19, internationally, we had that Euro-Pacific Growth Fund, and you can see there that they had a tough 2 quarters. But they, since we put them in, they've done a great job for us. But I do want to come back to them and maybe further diversify that part of the portfolio. But still, besides these last 2 quarters, they've done a great job for us over the longer term. And then we have our bonds with integrity. When interest rates almost double what they have, bonds go down. So our manager, just like every other manager, was down pretty significantly for the quarter. And then, like I said, real estate, the one good thing that we have working for us was up over 8% for the quarter, and then 18% for the fiscal year. So I'll take a pause there, but for the book, I got, it's a bad quarter. It's gonna be bad next time you see me, and we smooth it out, and relative, we're doing it could be worse. So are there any questions on the managers or the overall portfolio? Okay. So the next one is, it says international equity. So in our equity portfolio, we have, on the domestic side, we have value and growth. On the international side, we only have growth. And yes, it worked out for us for the last 7 years, the last 2 quarters. When growth has taken a step back, you saw the results there for the last 2 quarters. So my intent here is I put 4 international value managers in this book, and they would be to complement your Euro-Pacific growth manager. So the idea here is to pick one of these managers, take half away from your current international manager, and pair it with one of these. That way we're diversified like we are on the domestic equity side, and then we won't have these big swings on the upside or downside, and a more smooth pattern for our international stocks. Okay, so there's lots of numbers in here, and I'm going to narrow it down to about 5 talking points, and then we can see if you guys are in agreement, and then if you want to move forward with splitting this allocation. Okay, so if you turn to page 2 and 3. So again, there's so much information on here. I'm going to go through the 4 managers that I have here to review. I'm going to tell you basically the yay and the nay for all of them, and I'll tell you right up front which one I'm going to recommend. So then everything else that follows kind of supports my recommendation. Okay. So we have Causeway International, Dodge and Cox, Pear Tree, and then Transamerica. So I'll tell you, Causeway, good manager long term, more concentrated, meaning that when they get it right, it looks great. When they don't, it looks kind of bad. Also, they are contrarian value, meaning that they have long-term views. So they make investments in their companies. They have 5, sometimes 7, 10-year time horizons, and they wait and see. Obviously, it works for the longer term, but I can tell you as a board, when you have a contrarian manager, there is a year or two where you're like, why the heck do we still have this manager? And you have to wait it out. So I know this board has done it in the past, and you can do it. It's just a negative, and it's kind of annoying that we could be talking about them for a year or two when their contrarian views do not hit. So, but still, a good manager, but that is kind of one drawback. Dodge and Cox. This one, again, good manager, very volatile to the upside and the downside. Later this week on Friday, I'm in Mount Dora, and those managers have this manager paired with your current manager, Euro-Pacific Growth. And the one thing there is that their highs are very high, their lows are very low, and for it to work, when they have their highs, when they do very well, you have to be willing to take money away. When they look like they're the idiots in the room, you got to be willing to commit more money to them. Again, I know this board can do it, but it is very tough. When a manager looks awesome and we're taking money away from them, it's a tough thing to do. And when they look like we should be firing them and you're giving more money to them, that's also very tough to do. So, again, the Mount Dora guys have had that manager for over a decade, and they did it and it worked, but I can tell you it is exhausting having to talk about it and rebalancing back and forth, for basically once a year. So again, it will work, but it's just more leg room, more discussion we have to have in the meetings. Pear Tree, again, I had them also paired with your manager, a little more concentrated, more value, less emerging markets, so that they pair well. Have a little bit of a ESG component to their portfolio now. So I have no complaint there, but they are the most expensive, and I'll show you their fee. More concentrated, but they would pair well with your manager. And then lastly, I have Transamerica here. Again, lower on the emerging markets, which is good compared to our current manager. Low fees, and they're consistent. So I'll get into the risk, but just up front here, I would either look at Pear Tree or Transamerica, and I will be recommending Transamerica when we get there. But just the first two, even though I do like them, we have them in portfolios. It's just it's more of a hassle and work quarter to quarter for the board. So again, they're all good managers, but I would be leaning towards Pear Tree and Transamerica. Okay, so on page 4, just visually highlighted at the very top of page 4 the number of holdings. So I do have your current manager, Euro-Pacific. It's all the way to the right, so the third from the right. You can see the number of holdings they have is almost 400. So large, very diversified fund. And then as I mentioned here, you can see the others with Causeway and Pear Tree being more concentrated. Dodge and Cox is right there. And then Transamerica at 126, a little more diversified. So we already have a very large diversified fund. Again, I like Transamerica, just not as concentrated as the other three that are in this book here. And then in the middle with the colors, I did try to put the fee there, and then also the different sectors and how they're allocated. And you'll see there on a fee basis, our current manager is the last one in the colors at 0.46, so it's the lowest one. And then, Transamerica is not the highest one, but Dodge and Cox is lower, but it's kind of right in the middle from a fee standpoint. And then from a sector standpoint, kind of when I'm looking at these, I think that it does provide us with exposures to sectors that are not what we currently have. So Transamerica and Euro Pacific are right next to each other on the far right of the colors. And you can kind of see there that technology, which has gotten hurt, our fund has almost 20% in, all the way to the right in the blue. And then in the green is kind of defensive sectors. And you can kind of see there that ours has a little more heavy weighting or Transamerica does compared to ours. So when I go through sector by sector here, Transamerica does pair well with our current manager. So a little less sensitivity to the economic ups and downs, and a little more defensive. And then on page 7, talking about the emerging markets. So it should be highlighted on page 7 in the middle of the page. Again, ours is to the right. You can see there our manager has over 22% in emerging markets, a little more riskier. And then you can see how the others are allocated. So Dodge and Cox, obviously, you can see is high there at 16.74. And the other ones are lower, Transamerica at 1%. So again, this is why I think Transamerica does blend well with our current. We already have a ton of emerging market exposure, and Transamerica does not have that. It has a little, but only at 1%, and would be a good complement to what you currently have. Visually on page 9, so our manager is in the red, and this is the Morningstar style box. So you can see there in the red, our manager is growth, and then where all the other managers in the book, where they kind of lay. So they're all value, pretty much. And you can see there the one that I like. Transamerica is kind of right in the middle of everybody. So not dipping down like the green with Pear Tree, not furthest to the right, which is that contrarian value. Kind of just a good core value manager that will pair well with the red, your current allocation. And then, two more things here is on page 11 and 12 here. The one thing on page 11 here, this is like the trailing numbers, and I will go all the way to the right. So you can see over a 10-year time frame. They should be highlighted there, but you can also see the rankings. So the manager that I like, Transamerica, right in the pack of the best performing, ranking number 8 over the last 10 years. Obviously, our current manager right below there is the second best manager, but these other ones are still very strong. So even, Transamerica, from a consistency standpoint, long term, good manager by itself, and it pairs well with your current allocation. Page 12, I highlighted. I'm not going to go through all these, but you can see there just that no manager is the best one in any given year. So some do better than others. Kind of just highlight it there. To me, it just shows you that, no manager is the best all the time. You want to have ones that pair well together to limit that volatility year to year. And then the last thing, just from a risk standpoint, visually, page 17. So page 17 shows your risk. So if you just look at these four charts here, If the dot or the symbol is further to the right, it means it's more risky. If it's closer to the black square, it's pretty much less risky. So you can see there, your current manager on a risk standpoint is the closest to the benchmark, and then the triangle, upside down yellow triangle, is right next to it. And then the other managers, Causeway in the blue, Dodge and Cox in the gray, and then Pear Tree in the green. You can see over every time period is more riskier. So just in sum, all good managers, the reason why I like Transamerica is it doesn't have the contrarian value. So it could be out of favor for a long time. It's not, we're going to rebalance like Dodge and Cox, similar to Pear Tree, but a lower fee. Return standpoint, very consistent, but great long-term. Risk, out of all the managers here, it's the least risky. And from a sector standpoint and the emerging markets, it gives you a great complement to what you currently have. So for pretty much those 5 reasons there is why I think Transamerica would be a great fit to complement your current Euro-Pacific growth allocation. So kind of what I'm looking here is to basically sell half of your current allocation, and then we'll just sell that and then use those proceeds and buy half of the Transamerica mutual fund. So I will pause there to see if there's any questions on the rationale why I recommended Transamerica.
And you like them because they're both so close. They resemble each other so closely.
I like them because they're consistency. So I told you their process and the reason why, which kind of knocked out Causeway and Dodge and Cox. So consistency, long-term success, which we saw. Their sector allocations are different. Obviously there's some overlap, but pairs well with ours. The emerging markets was one of the lowest. Our current allocation is very high, so pairs well from a sector and country. And then from a risk standpoint, compared to the others in this book, it is the least risky. So you take great long-term numbers, consistency, sector and country diversification, and then risk. Add those 5 things up, and I think it pairs very well with your current allocation.
Okay. Looking for a consensus from us?
I make a motion, we follow the investment plan on the Transamerica International.
Need a motion or just consensus?
I look for a motion.
Motion? Okay.
Second.
Roll call?
All right. Aaron Soltz, how do you vote?
Yes.
Joe Mahoney, how do you vote?
Yes.
Miles Lawler, how do you vote?
Yes.
And David Williams, how do you vote?
Yes.
All right. Motion carries 4-0.
Awesome. So I'm super excited about that, and how it works is, I'm glad Inez is on here so she understands. I drafted a letter. Pretty much, it's going to be tomorrow. So we'll sell half of that tomorrow. Work with Michelle and Salem Trust, and we'll buy it's TSWIX is the ticker, and then in the next book, you'll see that it's in the book, and we'll be split there, and further diversifying the fund.
Perfect.
Okay. All right. I have one more administrative item, and I have a letter here to discuss. So this is not going to be fun, and I do want to open up for discussion. But I did put together here a proposed fee revision. So just how ANCO, our service works, is unlike your investment managers, we charge a flat fee. So your investment managers, when the market goes up, it goes down, they charge a % of fee. So obviously the market right now is a bad example, but it goes up more than it does not. But we do charge a flat fee. We do not have an escalator on there like some other service providers, but what stinks is that I have to come every few years and kind of ask just to look at the fee. So I won't go through this whole letter. It should be 2 pages, but at the bottom of the first page, I did highlight what all that we've done essentially the last 5 years or so. We got rid of principal, which was a big hang-up. That was a little more than 5 years ago. We completely changed our domestic equity and international. We just further diversified that today. We have a high quality fixed income manager. We added real estate within the last 3 years, which obviously you saw the numbers today was a huge benefit of why we've done so well relative to your peers. And then the bottom is just, despite everything that's happening right now, you can see there the 3, 5, 7, and 10. We have beaten your assumed rate of return over every time period. And you can see there how high you rank relative to every plan in the country in the universe. So we've done some great things here over the last several years, and the proof is in the pudding with beating your assumed rate of return and ranking so high relative to your peers. Okay, so the second page here is kind of where the discussion will lead to. Is back in 2016, at this meeting 6 years ago is when we had this discussion last time. And you can see there, upper left-hand corner, that was the retainer fee, was $16,500. I believe at that time it was discussed if we would like to put on a 3% escalator, and I would never have to do this again. And the board said no, which is fine. But you can see at that time on the left-hand side that assets were at 8.2 million, and as a percent, it was 0.2% or 20 bips. So you'll see there proposed that it is up $3,000 to $19,500. Given where I pretty much kind of copied this from last time, where the assets were, that as a percentage is 0.14. So yes, on an absolute basis, a little bit higher, but as a percent, because the assets have grown so much, even with a little the quarter you had here, still lower than what we agreed to 6 years ago. And then I did put in here when we talked about it last time about just having a 3% annual increase, which the board did not want to do. You can see there I have what the fee would have been each year if we did have that escalator on there. You can see it hasn't changed in 6 years. The savings annually, what that is, and then cumulative by not doing that, how much the board did save by not having that 3% escalator. So I know given everything that's happening, I had to ask for it. I was probably supposed to do it 2 years ago, but I let it go. But I think just looking at all the success we've had, given we don't have an escalator and we have to do this every couple years, I think the numbers make sense, and you can see how much by not having that escalator was saved each year, and then how much it's added up, on a cumulative basis. So if I'll open up for discussion, but just I made it July 1st because that's when the last one was. It was July 1st of 2016, and at 0.14, and that would be just like last time. It was guaranteed for 3 years, and obviously it's been 6. But the last contract was a guarantee for 3 years as well.
Okay. So is this one a 3-year contract as well?
Yeah, guaranteed. Yeah. So like I said, I should have done it 3 years ago, but I think it's pretty standard. We all have it in there for 3 years, and then we kind of review it. But we are coming up on the 6 years. So that would be an increase of only once. It's going to wind up being almost 10 years.
No, you understand. So 19,500 would be the new fee, correct?
Yes.
And that's good for 3 years, 19,500.
Yes.
Okay.
So even with all the inflation going on, we have to pay the workers, but the way we do it, yeah, that would be for 3 years locked in. So whatever inflation winds up being here, locked in there.
Okay. I'm okay with it. You got any discussion?
No.
Make a motion?
I make a motion to stay with ANCO, contract price of $19,500 over the next minimum 3 years.
I second.
Roll call?
Aaron Soltz, how do you vote?
Yes.
Joe Mahoney, how do you vote?
Yes.
Miles Lawler, how do you vote?
Yes.
And David Williams, how do you vote?
Yes.
All right, motion carries 4-0.
We should have made you work harder for that, man.
Thank you. Well, jokingly, I really do appreciate it. Great relationship, and I look forward to the next 3 years.
Yeah,
And thank you for your time.
Thank you.
Trustees and John, we'll prepare the fee addendum accordingly, but when is the effective date? When does the new fee kick in?
July 1st.
July 1st. Okay. Thank you.
All right, moving on to 6C, and that is you, Pedro.
Okay. So I think we covered everything with respect to the plan or the ordinance. So really, the only thing I wanted to cover with you is just a couple of housekeeping items. Nothing actionable by the board. First and foremost, I did want to remind you that your financial disclosure forms are due July 1st. Those Form 1s that we all love completing each year. So I did want to put that on your radar. You may have already received it in the mail. If you filed one last year, they've been going out later and later, but I think I was hearing from other clients that folks were starting to receive them right around early June. So you may have already received it. If not, it may be forthcoming. However, it is not a reason to file late or tardy if you don't get it in the mail. So, if you don't already have one, we can get you the form. I'm sure Michelle, the clerk's office, may have them as well. But you can Google Florida Form 1, and it should be the first one that comes up. But in any instance, if you can, just set a tickler for yourself to get that filed by the July 1. Call also. You can attach it to an email now, so it's a little bit more user friendly. Or, as in the past, you can mail it, certified mail return receipt, or hand deliver it to a supervisor of elections office in the county where you reside. Any questions or anything on that? Okay. Also, I did want to close the loop on the legislative front. There had been a bill, I went over with you guys, I think I reported at the last meeting, that there had been a bill filed that would have added COVID-19 as a presumptive disease. However, that did not make it through committee. So I would suspect that it will be reintroduced or refiled next session. But obviously we'll keep you posted on what happens. But nothing changes with respect to this legislative session, so there are no changes that the board has to be concerned with.
Okay.
And then really that's it. I know Michelle's going to go over some educational opportunities with you all, but from my perspective, that's all I really have for my report.
Great, thank you.
Yes, sir.
Moving on to 7, consent agenda. Now look for a motion.
I make a motion to approve the consent agenda as is.
Second. And roll call.
Was that Miles that seconded?
Yes.
Okay, great. Aaron Soltz, how do you vote?
Yes.
Joe Mahoney,
Yes.
Miles Lawler,
Yes.
and David Williams.
Yes.
All right, motion carries 4-0.
All right, moving on to 8, staff reports, discussion, and action. And first up is Foster and Foster.
Just wanted to let you all know the annual report was submitted to the state on May 16th. I'll keep you guys updated on that. The upcoming educational opportunities, so far all I have on our radar is the FPPTA conference from June 26th to June 29th in Orlando. If anybody wants to participate, let us know and we'll get you registered. And that's all I have.
Perfect. Moving on to 9, trustee reports, discussion, and action. Does anybody have anything to discuss?
No.
Nothing for me.
All right. I'll look for a motion to adjourn. So be it.
All right, everybody. Have a great day. Have a
Appreciate
good
it. Thank you.
Let me know if you need clients.
Okay, thank you.
Bye, Pedro.
Thank you all. Take care.
All right, guys.
Bye-bye.
Bye.
All right, and I got everybody's signature.
Pedro Herrera.
Has left.
Chat.
Pedro Herrera has left the building.
Got a couple minutes? We gotta run. The kids.
Oh, yeah, what's up?
She always asks for a raise in an upmarket.
I know.
Market goes to shit, and you're like, I need to.
He sold half the portfolio and asked for a raise.
Appreciate it.
Dude, it's so brutal. I can't even look at it. Oh my gosh! I looked at it this morning. I was like, oh.
Bye, you guys have a great day.
Yeah.
Getting way too cheap. Like, I'm waiting though. Apple is 99. That's all I know. I keep waiting. Keep looking at Apple. Come down to me. I'll probably buy them.
Then it'll go back up again. It always does.
I think I personally.
I think it's going to be tough here for a little bit, and then, like you said, like Apple's cheap enough.
Yeah, it's
People are going to get back in.
Didn't work out too
Yeah.
well. But yeah, dude, I told him, I texted him already. Be done. Line it up. Can't buy anything now.
But you got a while to go before you retire. What? Really? Trump. What? Yeah, that's true. We're in the middle of selling and buying right now.
I
I'm
will say
losing
though,
sleep over it.
everybody wants to move here. So like, it's different than the rest of the country.
Is it?
Like no one's worried about rates because like people will come down here and just buy cash. Oh yeah.
We're just like biting our nails. Like, when do we put our house on the market? Because ours isn't going to be ready. They said July 22nd, but there's no way the electricians haven't even done that. I mean, come on. So it's just a real nail biter trying to figure out when we're going to put it on
I think it'd
the
be fun.
market.
Like I said, people want to live here. So.
Yeah, I think.
Oh, then they've gone up so much. Yeah.
The last one. Cool. Your first last two, right away.
I don't understand why gas is so expensive. That doesn't make any sense to me.
The reason why it's so expensive is that when the administration like says that we're going to come down with all these sanctions on you, like all the gas companies are like, well, if that's coming, why would we invest in like capital projects? So they're not doing it. So I think a little bit of it has their like jacking prices up, but it's not. That's not like the whole thing. And then you can't just turn it back on.
Right.
So even if they do turn it back on, it's still like a year away.
All this. Yeah, we should be working.
It's not there yet.
Yeah, we're gonna go green.
Tomorrow.
Now we're.
Yeah, I don't understand why we're producing more oil. What's up with that?
Well, no, like I get why they're trying to cut it back, but yeah, they cut.
But don't they have a bunch of like what do you call it, permits or whatever? I don't even know what they call it.
Yeah,
like
but
the
they're
oil
not
companies.
you have to spend money to like drill it and stuff, and they're not going to do it because like the administration said that we're coming after you. Which I do get. Like I want to get off fossil fuels too, but we're not there right now. And then my father-in-law's a civil engineer, and like electric cars are great. You don't roll out like you charge a battery. Yeah, you got to burn coal and natural gas to get the electricity to charge it.
Plug my car in, I'm saving the earth.
Yeah, it came from a power plant.
It
Yeah.
didn't come from the sun.
Yeah, it didn't come from a wind farm, a solar farm. This whole.
Like stuff like I think in Florida, if you build a house like now,
Mhm.
you should be. I think I wouldn't. You should be made to put solar on that.
Yeah.
Like we live in Florida.
I would love to put solar, but it's so damn expensive.
Yeah.
Yeah, the return.
It's not there, but they should like get it. Like that's all the subsidy they should give people. Like, put it all on every house. I try not to do it, but like for some of mine, I have to. I do a Monday morning update.
Mhm.
Today was like very. I quoted Ernest Hemingway. That's how bad it is.
What was the quote?
Gradually, then suddenly. There's like some book that he has about some guy's like, hey, how'd you go bankrupt?
Yeah.
He's like, well, it happened two ways, gradually and then suddenly.
Some of those drops have been
Today, like I didn't say this, but like the Nasdaq, which is a lot of the tech stuff in there, it was down 5% today. I mean, they bounced back while we were kind of talking.
I'm afraid to look at it. I saw.
Yeah, well, it bounced back from like I think when we started, it was down 5. Now it's
Yeah.
like up to 3.
The only thing green in my entire account today is I have a short.
You have a what?
Short.
Position on the S&P 500. But, that's the only thing green holding.
At some point though, like S&P's at like 3,800, give or take. Like the next threshold is 3,600, and then 34. I just can't see it going much lower.
I keep saying that. I mean, no one's. I don't know. Where's the money? I don't know. Everybody's like, the average person. Like all my buddies are. They're all touching.
Oh, we have been hoarding our money. We're
Well,
just
somebody's
going with
buying
our-
it.
Somebody is buying.
Well, see, I've seen credit cards the last 2 months. It's the highest. The last 2 months, the highest it's ever been.
Really?
And savings are negative. So basically, people are, on average, we're still spending money. We're doing it through credit cards and savings.
Wow.
This economy. Everyone knows it's easier said than done. Trying to make money is. Some
Yeah.
things are really tough. But it's painful.
I know, like personally, I'm about to. Yeah, I mean, I have a long time horizon, and yeah, it's gonna get lowered up. It's like, well, you know,
Yeah, I
No,
mean,
no,
I
I
can
mean,
see
for the
it.
next.
I'm thinking the same way.
Yeah,
I'm like,
it's like,
I've been
gonna come back.
easing in, too early. At this
Yeah.
point, it's like, it's been a month or so. And I'm like, ooh, this is now it's cheaper. If you like something, whatever price, it's cheaper.
Unless you're like, you know, older and you're retired and stuff, then you gotta worry about it. But like longer term, like it's gonna come back. And like you should be like viewed as like you're buying it. Hey, it's a heck of a lot cheaper than it was in January.
Find it on sale. I couldn't talk my husband what he thought. Now's the time when I'm getting into it. I didn't call him a ding dong.
I up my like. I don't even look at this. It's 4%.
Right.
I don't even look at. I upped it last month.
Yeah, I do.
I find if you look at it like you're buying shares or whatever you're buying,
Yeah.
it makes it oh, well, I'm buying more shares now. You
Don't
know,
look at
and
the
then,
dollar
and then
amount.
later on look at the dollar amount.
Yeah. That's smart.
But I have like this with my wife and I have like a sapphire. I have all this other stuff too. We're about to list up. I just buy the S&P 500. But yeah,
Not the Nasdaq.
I just buy the S&P 500. I mean, to be honest, they're very close.
I almost did. Oh, you can't build it. You ding dong. Who's gonna get scared first? Let's say the economy. Builders are gonna suck. They're gonna get scared.
Yeah.
Then you got even worse. We're in for a bunch of money.
They better finish my house.
Well, they already have your money. They'll finish your house. They want to get paid.
So
But new capital, they might.
my neighbor is North Florida president at Pulte Homes. So I just talked to him and stuff. And yeah.
Yeah, it's getting.
And then, he was saying even when they build a house, it's like he has had to go to Home Depot just to buy a fridge.
told us, don't bother buying furniture, just go to Home Depot and get it.
Yeah.
It's gonna take us forever and they're gonna overcharge you.
My buddy just they bought a new living room, 5 months for a couch. Come in.
Yeah.
So my parents just bought my grandma's house and they're moving in, and they kind of wanted new furniture, you know,
Mhm.
like new beginnings, like that, some stuff happened, but like yeah, it was like 5 months.
Mhm.
Well, your other furniture's fine, you know. You guys want to have friends over.
Oh my
I
God.
do want
Nobody's coming over except
I do want to
my little
go.
brother.
I am cutting back spending.
Hey, I need a copy of this stuff.
Yeah.
Just they want this. Whoever did it. They want this. It doesn't hurt their house. It really does. It doesn't hurt the rich. Not really. You know what I mean?
Yeah, no, it hurts everybody. Yeah, but proportionally.
It hurts the middle class so much.
Like the one nice thing with, at least with energy, is that like back in the '70s when we had this issue, I think like energy, like not only gas and cars, but like your house and all that stuff, was like I think like 35% of people's dollars that they spent. So like yeah, when that all happened, it was awful. We're now like it's down to like between 5 and 10, and obviously for poor people, it's 15 to 20. So it's not like it was. So that's a good thing. That's like what has increased the most.
You're waiting for the next level, 3,600? Is that where you're
I think
looking?
so. Well, I get paid differently, so I get paid 4 times a year.
Oh, really?
It's like it.
That's tough.
You only get paid 4 times a year?
Yeah. So once you get used to it, though.
Yeah. That's
Yeah, and
true.
then you like make it work. But yeah, so I got my next one's coming, and I can basically it's all going into the long one. Yeah.
There has to be.
I think it's getting there. Yeah.
Some people just everything.
We're getting like I said, it's 36 and then 34. I just can't see it going much lower.
I mean, their stock's trading at book value.
Yeah.
I mean, it's wild. I mean, it's just. I like tech a lot, man.
It's not going anywhere. Like they were. I think
It's the future.
they were like overvalued. They were, but if you think about like what's growing, we're all growing cyber or something.
Yeah, I mean, I like although it's she gets hated on. I like read some of their stuff. It's all about
Yeah,
innovation.
she's getting. Actually, there were some like positive articles.
Was there?